fourth quarter 2022 capital markets and economic perspectives. Every quarter, we try to share this information with our clients and also prospective clients and really anybody, financial advisors who enjoy using our portfolios. This is just sharing our insights and what we're seeing in the marketplace, and also how our strategies have been performing and what have we been doing. And it's been pretty busy lately. As you probably all have seen, the capital markets have been very hectic, and we see that sourced to some specific issues. So we're going to talk about those today. And with that, we'll go to our disclosure page. And of course, we're in a highly regulated industry. And you can see here, there are a lot of specific items. So screenshot this and read this thoroughly. Or you can reach out to myself or anyone here on the Align Wealth team, and we'll be happy to provide these to you following this presentation. So this slide talks about the archive that we have at Forbes. My articles I submit every month to the editors of Forbes, and they'll publish it and usually provide some good editing along the way. But there's a few years worth of forecasts and different economic commentary that I've recorded there. And one particular one that someone reached out and sent this to me the other week was an article I had written back in December of 2001, which was entitled "The Maturation of U.S. Treasury Debt Held by the Fed May Pose a Big Challenge." And this article was actually written towards the end of October of 2021, when the Fed funds rate was around 0%. And the upper bound was at 0.25%, somewhere in that area. And certainly this year, it's been a big challenge for the Federal Reserve. And so, forecasting is at the core of what we do around here. And it's certainly impossible with any high degree of accuracy to predict what will happen next. The idea is that there is data, and there is plenty of econometrics, and there's just really a tremendous amount of information available. And it's not about the information, it's really what you do with the information, what conclusions you draw from that information that really matter. And so in our investment strategies, we're really looking forward. We're not looking in the rear view mirror making any decisions. We're really looking forward, and that's, I think, what most people would want, from their investment advisor. So just to summarize, a couple of things that we did during the third quarter in terms of allocation changes. In July, we did a simple but comprehensive portfolio rebalance. And this was just to our target allocations that we already had been maintaining, which included a high allocation to cash across all of our strategies, the 4 core strategies that we have. And that meant we bought some more financials and emerging markets and U.S. mid-cap stocks. And we sold a little bit of energy, healthcare, and developed non-U.S. These were very minor adjustments, but an important one. And in August is when we actually had much more significant changes made in our portfolio. We reduced our stock exposure and we increased our fixed income exposure. And so what this meant is that we actually sold the remaining amount that we had in an S&P 500 index fund, specifically a market cap weighted index. So when you hear about the S&P 500 every night on the nightly news, that's a market cap weighted index. And we had been selling that over the past couple of years. And this past August, we took the opportunity to sell the rest of it. And we bought a short-term investment grade bond fund And we're beginning to see yields that are actually quite attractive, and that's a good thing. I think for all investors to be able to see that, especially retirees or folks looking for some kind of cash flow coming into their portfolios, you can find that now, which is very refreshing after a decade of not being able to find that. And so we took a position and actually increased our position in short term, but just going out a little bit further in maturity. And a fancy word for that is duration. I suppose the most significant thing of this is that we underweighted stocks for the first time relative to our fixed income allocation in our strategy's history. So this was kind of a big moment for us. It's always a bit of a risk when you are deviating from something you've been doing for a long time in any strategy you've been running. And so being underweight to stocks was a move that we felt very confident in. And of course, we don't look at how things have been performing in the short term to gauge whether that's been a very good decision or not. But for the time being, that seems to be playing out well. So the next couple of slides I'm going to share with you are research highlights, just to give you a little bit of an insight as to what we're seeing and looking at, and also how we come to the conclusions that we come to. And so what you see here are actually the target federal funds rate, the upper limit for it, which currently is at 3.25%. And the Federal Reserve has actually been indicating, as well as some of the committee members, that this may go well into the 4% range, 4.5, maybe even 4.75 sometime next year. So what we see in this orange line is really the fastest rate hike that we've ever seen by the Federal Reserve in the U.S. So it is you can't really describe how phenomenal this rate hike sequence has been and how fast it has been. And you get a little bit of a sense of it where, here, March of 2022, just a few short months ago, we were, basically at 0.5% on the upper limit, and today at 3.25. So very rapid rising. And in the purple is the U.S. Weekly Economic Index, which is really a collection of many, many different economic data points, from labor to production and manufacturing and unemployment claims. And you really get a very nice sense of where and what the state of the economy is at any moment in time on a weekly basis. So it's a very contemporaneous indicator of where things are at. And you can see just over the past year, this has come off quite a bit from a peak near around, a little over 6.5, all the way down now to around 2 in the most recent reading on October 1st. So this has been the intended impact that the Federal Reserve wanted to see. They want to see economic activity slowing down. And so this is a good sign that their rapid rate rise is having the intended impact. But really, this is more about the Fed playing catch up. They waited too long to begin to raise rates, and they also waited too long to begin to sell bonds or allow bonds to roll off of their balance sheet, which we'll see in just the next slide. So there's a lot of things going on this slide. There's several different lines, and that can always be a little overwhelming. Basically, let's focus on the fuchsia line and the light blue line. That is both manufacturing, the U.S. Manufacturing Index. And even though the U.S. is primarily a services economy at this point, it's nice to look at manufacturing. That we're still building cars here. You probably heard the news that now we're going to start, making micro chips here in the U.S. So manufacturing is not dead in the U.S. It is still very much a vibrant part of the economy, although not the dominant part. And then also looking at the U.S. existing home sales. And you can see those have come off quite a bit over the past year. So this is just looking at the past year. So down, over 16% in manufacturing, although the raw number is still above 50, which indicates, some health to that particular sector of the economy, but it's really come off its highs. And home sales down nearly 22.5%. So that is quite significant. And we think we may be seeing just the beginning of a very illiquid housing market. And then you have this contrast with these other parts of the economy, namely U.S. retail sales, which really have continued to be quite strong. And this is probably the most challenging part for the Fed in a lot of their decision making and the rate hike cycle that we're in, is seeing that people are still spending money and happily doing so. And actually spending money, the retail sales are up as of the latest reading, 6% over they were last year. So this really has to go down, and it has to go down dramatically, probably before the Fed is having more confidence in stopping the aggressiveness in their rate hikes or the magnitude of their rate hikes. And so we'll be watching that very closely for an indication of how things may play out, or how calm things may begin to get from a rate hike cycle. And one of the indications of how that may be going is the U.S. total assets held by all Federal Reserve banks. And that is actually up 3.28% over where it was at this time last year. So even though we're in this rate hike cycle, and even though we're in now this very clear contractionary monetary cycle, meaning the Federal Reserve is looking to sop up all this money that has been circulated in the U.S. economy from all of these different initiatives, mostly fiscal policies over the past couple of years, post-pandemic, during the pandemic. And so the Federal Reserve actually still has more assets on the books than it did a year ago. And so we must see this decline in order to see really the impact from this contractionary monetary policy that they currently have in place. So this hasn't even begun. We haven't even begun to see that figure budge. And also the labor markets are pretty much holding very strong, and the labor force has actually grown about 2%, 1.91% over the past year. More people coming in to the labor force, and so there's this very, very interesting dichotomy between certain sectors that really are getting very weak already, and other parts of the market and really the economy that are extremely strong. And the Fed is watching those things very closely because they need to see a downtick in that. And you may hear this word stagflation, which that Forbes article I wrote back in December of 2021 that was referencing. The last word of that article is stagflation. And that is perhaps our greatest risk that we would face going forward, which is a period of still inflationary pressure, but higher unemployment and shrinking GDP. And that's a very difficult thing to manage through. And so I'm sure the Fed is doing everything in their power to avoid such a scenario. But the reality is they don't control every aspect of the economy or the capital markets by any stretch of the imagination. So they're just moving in a direction, hoping that market participants are on board and moving along with them in some kind of orderly fashion. So here's I think one of our more interesting pieces of research, which is looking at the strength of the US dollar. So if you are getting ready for a European vacation at some point during the holidays or whatever it might be, the euro and the British pound have been clobbered, as well as the yen. And so there's incredible strength of the US dollar. You can see down below there just the recent history since the beginning of 2021 through the end of September 30th, that there's been basically a 25% increase in the value of the US dollar. And this is a dollar index, so it looks at a basket of currencies on a trade weighted basis. And so a 25% increase over the past year is pretty significant. Really, year and a half, year and a half plus is quite significant. So, we look back at time just to give us an idea of how a period may have looked like in the past and how did that play out over a subsequent period of time. So we look back to 1999 through the end of 2001, and we saw that there was about a 24% increase in the strength of the US dollar. Exact same index that we're looking at. It is very eerie to think that that increase in strength of US dollar is almost identical to what we've seen over the past year and 3/4. So that would give us pause for thought. There's something, there's a strength here happening that has more or less been mirrored to some extent in history, and also that history happens to coincide with the 2001 recession. But what happened afterwards? And so from 2002 to the end of 2004, you saw a significant decline in the strength of the dollar, more than 30%. So you get this big run up in strength for the US dollar, only to be seeing how much it really goes off a cliff over the subsequent couple of years. And so that's basically our question here, which is what happens in 2023, 2024? Will we be revisiting a period of US dollar falling from this very phenomenal strong period? And the likelihood from our standpoint, and certainly how we are positioned in our portfolios, is that we would expect to see this reversal, and that the U.S. dollar would in fact lose some strength, and that's something to be cognizant of from a capital flow standpoint. When the U.S. dollar is as strong as it is, and we're basically exporting a tremendous amount of inflation to everyone all over the world, and so it's one of the reasons why we've made certain adjustments in our portfolio that I'll talk about in just the next slide. So here we get into some of the narrative around our economic outlook and capital markets forecast. For the equity markets, we are anticipating continued stock market volatility here in the United States, and it'll probably worsen. Our guess is it can get worse as the Fed maintains an aggressive, restrictive monetary policy. So, today there was some mention in the news that there may be a little bit of a pivot, or maybe not so aggressive, by one of the committee members at the Fed, and of course the markets get excited about that. But ultimately, we think this overarching theme of continued restrictive monetary policy is something that the U.S. stock market has to be aware of. Non-U.S. stocks, both developed and emerging, remain more attractive to us and in our portfolios. U.S. small and mid-sized companies may offer some valued hedge versus the large cap US stocks. And this is really due to this fourth point, which is that when you have a very, very strong US dollar, this can really weigh heavily on large cap foreign revenues, since these large cap multinational US companies could get anywhere from 40–50% of their revenues coming from foreign sales. And if it's just very expensive because of the strength of the US dollar for them to be buying that, then they're going to stop buying it, or certainly scale back their buying of it. So that's a very important thing to keep in mind, because we really haven't seen that show up just yet in large cap revenues. So something to be on the lookout for. And interest rates or yields, we are expecting to see an increase in risk perception just based on debt service coverage and the challenge that many companies may have because yields are going higher. And the vast majority of investment grade bonds that are currently in circulation in the US economy are rated triple B, which is just one grade above junk bond status. So that also gives us a little bit of pause for thought to think about, well, maybe the bond market really hasn't seen, um, it's, really fully absorbing all the risk that is out there just yet. And certainly when you look at the maturity schedule related to corporate debt, this really has a lot of refinance pressure. And so with these higher interest rates, it definitely complicates the cash flow decisions that CFOs have to be making. How do they maintain their credit rating? They're probably going to have to reduce costs. What's an easy way for CFOs to recommend to the CEO to reduce costs? Usually reduction of payroll. And so that is where we could see increase in unemployment and unemployment claims. There are, on the bright side, there are opportunities to enhance portfolio cash flow with bonds, and we haven't seen this in over a decade. So this is kind of a big deal. Been well over a decade that where we've seen any kind of attractive return coming from bonds, and now we're beginning to see it. And that's actually very exciting for investors and something to truly celebrate instead of everybody being very dependent on stocks to provide cash flow, especially for retirees who would maybe sell a little bit of stock that's gone up. And so they'd use capital growth as a source of funding or supplemental lifestyle expense, supporting their expenses in retirement, and that isn't the way it was for decades prior. So this past decade has really forced the behavior of utilization of stocks in a way that isn't quite normal historically. And even short-term rates are offering a good value relative to intermediate and long bonds. And this is really due to the inversion of the yield curve, which hopefully we hope it won't last very long. If it does last very long, meaning another few months, that's going to create tremendous challenges for several parts of the U.S. economy. So that is something to also be on the lookout for. And then just looking more broadly at various economic data points, there's an exceptionally tight U.S. labor force, and still millions haven't returned to work post-pandemic. So this is very strange, and yet unemployment's very low, and labor force has been improving somewhat. U.S. productivity was actually negative in the first half of this year. So if you've heard this term quiet quitting, we see it like in all these posts, people are talking about quiet quitting. Well, this is quiet quitting. When you see negative productivity, so people are working, there are hours being logged, but the amount of production that's coming as a result of those hours being worked is less. And so there's just not a lot of productivity within the labor force, and that definitely clouds future growth. So there's something very odd here. And most economists that we track and read their work are very concerned about this particular dynamic. So we'll be watching that as well. And also there is some anticipation of a higher unemployment rate rise, as well as unemployment claims. And it's all connected to these prior issues. The Fed balance sheet may shrink by at least $500 billion in the next 6 months. An important point here to make is that just a decade ago, the entire balance sheet of the Fed was about $1 trillion. So here now they're rolling off about 90 billion a month. That's the plan. So we would expect to see $500 billion roll off their balance sheet in the next 6 months, and that's going to just create this tidal wave of really money leaving the U.S. economy, and that's what creates quite a lot of complications, and certainly has been driving rates higher, mortgage rates higher, and we could continue to see that. Just to touch on performance, because we do manage 4 different core strategies from low growth to aggressive growth, just highlighting those here. We'll have quarterly fact sheets for each of them available over the next week or so. But in 2022, bond and stock selection has made a big, big difference. It really mattered what kinds of bonds you bought. It really mattered what kinds of stocks you owned. You were still going to be down, but you would be down by less. And so we had some decent outperformance year to date. As you can see here, those who are logged into our presentation, you can see the year to date, 1 year, 3 year, 5 year, and the inception to date cumulative, as well as annualized, and the same for the aggressive growth strategy. In both instances, there's been outperformance, but driven by different things. And you can see the outperformance on the bond, more heavily allocated bond portfolio has been better because some of the decisions we made allocation-wise when it came to our bond allocations just had more impact relative to the kinds of decisions we were making on the stock side. So this business is always about what's next and what happens next. So looking in the rearview mirror doesn't really help you at all. And so we don't put too much into any of that. But we're certainly not through the wilderness yet. We'll keep you updated through YouTube. We have a YouTube channel, which you're certainly very welcome to subscribe to. And there's monthly updates, shorter versions of this that just give little snippets of research and what we're up to and what we're seeing. Or you can visit our website and go to the For Advisors section and see some research highlights as well. And you can also see the investors section for clients, which has the YouTube link there also. Thank you so very much for joining me, and hopefully you found this informative. And of course, if you do have any questions, you are very welcome to email us at info@alignwealthllc.com, or you can give us a call here in the office at 310-795-0622. Otherwise, I am available to take some questions right now, and the Q&A is open. So if there are any questions, you may submit them. And otherwise, thank you so very much for joining me, and look forward to seeing you again.